But let's first start talking about an inflationary crash. All right, now let's go back to the 1920s, about 100 years ago. After World War I, Germany was forced to pay war reparations. So they had to go pay for all the damage that happened. And by doing that, it caused them to go into a massive period of hyperinflation. As a matter of fact, it's one of the most commonly cited textbook examples of hyperinflation. So this is the Weimar Republic in Weimar, Germany in 1920s. And it's a textbook example because it was one of the most extreme cases of hyperinflation in history, although I would argue Zimbabwe is actually worse, which we'll cover in a minute. But what happened is, like I said, after World War I, they had to go pay for all these war reparations. They didn't have the money, obviously. It was known as the Treaty of Versailles, and it imposed reparations initially set at 132 billion gold marks. So back in those days, gold was still money. Gold was actually money. Paper was backed by gold. It was a paper certificate that marked gold. And so the US dollar, 32 US dollars equaled, well, in 1920, it was 20 US dollars equaled 1 ounce of gold. Germany was the same way. 132 billion gold marks was what was owed. It was equivalent to about 33 billion at the time. Now, of course, because our money continues to be debased, it was 33 billion at the time. Today, it's 553 billion. Over $500 billion is what Germany owed, which is an enormous amount for any country, but especially Germany back in that time. So there's an enormous amount, massive economic burden, and they didn't have the money, obviously, and so they had to print the money. Now, just to kind of put this into perspective again, today, in today's dollars, the largest debtor nation to the IMF, the International Monetary Fund, is Argentina. And Argentina owes about $31 billion. 31. Okay. So back then, Germany owed 500, over 10 times more. Okay. Just to put that into comparison. Now, let's look at this hyperinflation. So before this started happening, you have to remember, like, we don't want money. We want things that we can exchange the money for. So we always have to look at exchange rates of different things. And remember, gold was still money at that time. So if we go back to 1914, which was before all this started happening, we could see that the exchange rate for German marks to gold was 4.2 marks to 1 US dollar, or it was 2,790 marks per ounce of gold, right? Because remember, it's exchangeable for everything. So 4.2 marks for the dollar, or 2,700 marks per ounce of gold. But if we fast forward 9 years, this happened over a 9-year period, after hyperinflation happened, by late 1923, we saw those exchange rates just take off. As a matter of fact, 9 years later, it took trillions of marks to buy an ounce of gold. Instead of 2,000, it now took 4.2 trillion marks, trillions of marks to buy an ounce of gold. And the exchange rate, which was 4.2 marks for US dollar, was now 4.2 trillion marks to 1 ounce of gold. Trillions, from 4 to 4 trillion. It's a pretty big deal. Now, of course, that was devastating for everybody in Germany. And what happened is, this is a very important piece. I talk about it often. There's a book titled When Money Dies. It's highly worth reading the book to get some of these lessons. They talked about what it was like living through that period. And one thing is, the people saw their asset prices shoot higher. They saw their homes gold higher, all these things. And they said, oh, we better sell our house. We better sell our gold. We better sell our assets before they crash back down. So they all did. And they ended up holding a bunch of worthless paper that they ended up burning in their fireplaces because it was worth less than wood. But the point that I want to talk about here is that home prices shot higher, and food prices shot higher, and all these assets shot higher. But the problem is that the workers' pays didn't shoot higher. And so even though asset prices went up, which seemed to be a good thing, they couldn't afford them. That led to massive political instability. It led to extremist groups, and eventually is what led to the Nazi party coming in and Hitler taking over and capitalizing on this to take it over. So in this environment, we saw the asset prices shoot higher. But because the pay didn't keep up, even though prices went up, not down, people lost their quality of life. We can look at Zimbabwe. Zimbabwe is even a better example. In the 2000s, not that long ago, in the last decade or 2 decades, we saw massive hyperinflation. We saw currency collapse, economic breakdown. Let me give you an example. In 1983, the exchange rate was 1 Zimbabwe dollar for 1 US dollar, 1 to 1, 1983. By 1997, it was 10 to 1. So it took from 83 to 97, what is that, 14 years to go from 1 to 10. But then from 97 to 2000, so now that's like 3 years, it went from 10 to 1 to 100 to 1. By 2002, 2 years later, it went from 100 to 1 to 1,000 to 1. By 2005, 3 years later, it went from 1,000 to 1 to 10,000 to 1. And by 2006, 1 year later, it went from 10,000 to 1 to 500,000 to 1. At that point, they're like, okay, throw this away. That ain't working. Let's try again. By August 2006, they came out with a new dollar, a new Zimbabwe dollar, the second Zimbabwe dollar, an exchange rate of 650 to 1 US dollars. By 2008, 2 years later, it went from 650 to 700 trillion. Okay, throw that away. Scrap that. Let's try a third time. August 2008, it was at 1,780. And by November of 2008, just a few months later, it went to 13 quadrillion. I'm not making this up. From 1,780 Zimbabwe dollars for 1 US dollar, it went to 13 quadrillion. Now, what happened? Well, everybody became a billionaire. Everybody in Zimbabwe was a billionaire. Amazing, right? Wouldn't you love to be a billionaire? But the problem is, it was $350 billion for one egg. So while everybody became billionaires, you needed 350 billion to get an egg. And so the point is that markets don't have to crash. We could see home prices double, triple, quadruple. We could see gold and oil and all those things double, triple, quadruple. We could see your retirement accounts go up by double. You could even see your pay go up. But if the cost of your goods and services goes up even more, you still end up in a crash environment where you can't afford the same quality of living. Does that make sense? Okay. We've seen this over and over and over again. Argentina right now is seeing the same thing.